Thanks for coming this evening. Today we're just here for the Executive Summary Workshop, and we're privileged to have Eric Engineer here to present this wonderful workshop for us. Eric is a Senior Associate at 7 Rosen Funds, and that is a Dallas-based early-stage venture capital firm. He focuses on early-stage investments in software, media, information services, communications, and computing. And prior to working with 7 Rosen, Eric was working at Microsoft as a product manager for Windows Mobile, and he was also product planner for Windows Embedded. Before working at Microsoft, he was a sales engineer at Trilogy, which is an enterprise software startup in Austin. And Eric has a bachelor's and master's in computer science from Rice University, and he also earned his MBA from the Harvard Business School. So please join me in welcoming Eric.
Hey guys. Thrilled to be here. I love coming out to SMU. I've come here a few times before, helped out in the business plan competition, and it's always a lot of fun. I was hoping to keep today really casual, so feel free to get food and drinks in the middle. Feel free to interrupt me and ask questions. I may ask you guys a few questions, so I'd love your participation. But the idea here today is to give you guys an overview of the way that, at least in the venture capital community, how we think about executive summaries, which are a really important tool for the fundraising process if you're an entrepreneur. You have your executive summary of your business plan. You probably also have a pitch, PowerPoint deck. You'll also have maybe a more thorough, longer business plan. And those are kind of the tool set that you'll have. But the executive summary is what people usually use when they're introducing themselves after they've maybe met at an event or something like that. You probably usually just email me, hey, here's the executive summary. Let me know what you think and if you want to have further conversations. So it's really important in terms of getting people's attention and being able to convey your message. So that's why people spend a lot of time thinking about what they put into it and more importantly, what they don't put into it. I think the most important thing you can think about is how you can be concise and consistent, and you'll see that theme throughout what I talk about today. But before I start, I've been asked to put a few kind of housekeeping slides up. First thing, I guess, these are certain important dates relative to the business plan competition that you should be aware of, in case you're not. And I guess there's a new date at the bottom there that you should take note of. These are the cash and prizes that you'll be competing for. All right, so yeah, these 2 words, if you remember 2 things from today, it's the 2 C's of being concise and consistent. So what that means is shorter is better. I've been told that I think you've been asked to keep it under 5 pages, is that correct? Which I think is great advice. Some other competitions that I've been part of don't provide that guidance, and I think that leads to some really long and unwieldy business plans and executive summaries. So 5 pages is good. If you can get it down lower than that, that's even better. But you want to make sure you convey everything that you're trying to convey. And the most important thing beyond that is to be consistent. I can't tell you how many times I will read one part of an executive summary and then read another part and I say, hey, this doesn't really make sense. If this holds true, there's no way that this holds true. And that immediately destroys any credibility you have with an investor, because then it just signals that you haven't really thought through the whole thing, that you've been maybe superficial about how you've addressed your business plan. So just remember those 2 and you'll see them throughout. This is the judges' scorecard that I believe the judges will be using when they're assessing your executive summary. I've used this one in the past. I think I helped out 2 years ago for this competition, and I also helped a lot at the Rice Business Plan competition, and it's pretty similar to this. So this doesn't necessarily mean that these are the 8 sections. Some people like to use this as a guide in terms of the sections that they use. That's fine, maybe not always in this order, but what's important is that you address all of these issues, and that's how the judges are going to think about it. So what I'm going to do today is I'm going to walk through these 8 sections or 8 areas, and I'm not going to go through and list everything that should be included in each of those. I think that's pretty straightforward. What I'm going to instead focus on is things that you should definitely not miss, and things that where people make mistakes often, or so it's kind of more subtle things about how you present the information. So first, company summary. This is probably the most important part. So think of this as the exec summary to the exec summary, because honestly, I don't read, when I get executive summaries, I'm not going to read all 5 pages sometimes. Sometimes I'm just using the first paragraph to assess whether I want to spend more time on it. Because most investors are wading through hundreds of executive summaries that they get through different sources, and the ones that stand out are the ones that grab attention right away and convey the full message, but in a very concise way. So I would think of it as kind of like your tweet or Twitter. Like if you could put it in a Twitter message, that's the ideal situation. If you can get it down to 1 sentence or maybe 2 or 3 sentences that really capture 3 areas, which I'm going to talk about, very, very concisely, then you're doing an excellent job. The first that you want to make sure that you get across is the problem that you're solving and for whom. So that means who's your customer, and be very precise about that, and what problem are you solving for them. And in any way, if you can convey that this is an important problem for them, that's even better. The second thing is that if you can get this down in that short summary, is very upfront about what your market positioning is or your advantages. So I'm assuming some of you guys have taken marketing classes. You understand the importance of product positioning. This is equivalent to that. It's the position that your product is going to take relative to your competitors and what place in people's mind it's going to hold. But it also talks about your underlying advantage that allows you to take that position in the market. And the third thing, if you can squeeze it in there, and I know this is hard to do, is not only talk about your initial strategy, which usually means this is your first product, but if you can convey a longer-term message or ambition of what you want to become over time, that you say that this is a huge opportunity in 3 to 5 years and you're going to be, the leader in this bigger space, but this is the way you're starting off, that's a great way to get the attention of some investors who really are looking for, like myself, who are looking for companies that can one day have the potential to become very large. So if you're addressing that kind of investor that one day is looking to not, it's not going to be kind of a mom and pop business or a lifestyle business, but they're looking at it more as a venture investment that is going to one day maybe generate tens or hundreds of millions of dollars, then you have to be able to explain what that broader vision is, not just the 1 or 2 year focus that you have. Again, so that's a lot to be able to put in a short paragraph, but if you can do that, it's very powerful. The next area that you're going to be judged on is your analysis of the customer. And so we talked about, being able to address what problem you're solving for the customer. But there are certain things that you want to be clear here about, which is, okay, fine, you're going to talk about what problem you're solving and how you're addressing that. But more importantly, you should have a sense and be able to tell the investor how people are handling this problem today. And so that can take 1 of 2 flavors. Either they're already handling the problem today and they're not happy with the solutions out there, it's an incomplete solution, or they haven't faced the problem yet. You're anticipating that they're going to start facing the problem because of certain trends that are happening in the market. And so you're kind of getting ahead of the curve there. And those are 2 very different things, because if you understand that and you can relay the dynamics there, it really affects how you approach the market. Whether you're trying to displace existing competitors that are trying to solve the problem, or the other problem is if the problem doesn't exist but it's going to exist, you're going to be the person having to evangelize and make people aware of a problem that they don't even know they have, which can be really hard. So understanding this, showing that you have a grasp of what your customer's perspective is on the problem is vital. And the other thing to make sure that you're addressing when you're analyzing your customer is what people call adoption friction, or what's going to get in the way of people adopting your solution. So the first one was similar to the one I mentioned earlier, which is, are they even aware that they have this problem, or that they're going to have this problem? So you would be surprised how many times you talk to customers for startups that I'm looking at, and they don't even think it's an issue. And it's kind of in the head of the entrepreneur. And so you want to make sure that the customer is aware of it, or is aware that it's going to happen. The best situation is if you can show that there's real urgency around the problem you're solving. And this makes more, and these make more sense for kind of B2B type businesses when you're selling into a business. But if you're doing a consumer product, I'd say the equivalent of this is what behaviors is the consumer exhibiting today that really makes you convinced that they're going to adopt your service. because they behave in a certain way. Maybe they have a, Facebook, maybe or Twitter, there's a need for self-expression or sharing, and that's inherent in human beings, especially maybe in certain demographics. And so, if you can say, hey, these are the ways that people do that today, and this is a better tool for doing that, or makes it easier, or what have you, that's important. So it works both for consumers and for businesses, but you want to make sure that people are aware of it, that they express behaviors that show that they're aware of it, or that they're spending money on solving the problem, that they feel it's urgent, they're struggling, there's press about it, people are talking about this issue. That's all good stuff. The other thing to think about is this a medicine or a vitamin if you're solving a problem? So, if you're prescribed medicine by a doctor, you're taking it every day because this is a pain that you're feeling, this is an issue you're facing. And versus a vitamin, which is kind of nice to have. It's something that you want to do because it's going to make you healthier, but you don't necessarily feel the short-term impact. Investors prefer medicines over vitamins. And so as much as you can position yourself as a medicine rather than a vitamin, the better. And then you're also looking in this section here to talk about and be able to show evidence that people are willing to pay for what you're selling. It's great that people will adopt it for free, and there are a lot of models, and we'll talk about that later, where that's maybe all you need initially, and then you can figure out the business model later on. But it's even better if people have shown a propensity to pay for something, and you understand what the price point might be because they're spending X amount of dollars every year in this area. It might not be on your exact category because it's a new category, but in this broader area, people are spending money. They already have a budget allocated for it, so it's not going to be this kind of evangelizing process within the company or your customer to try to sell it. Similarly, if you're doing a consumer thing, yep.
Should we cite the evidence throughout the process?
Yeah, absolutely. I think,
In terms of like just saying exactly where we got it?
Yeah, when I say evidence, I really mean, you want to say, hey, we interviewed 5 potential customers in our target, segment or whatever, and they all expressed this frustration with the existing solutions to the problem today. They spend X amount on it already. That kind of evidence is really important. If you don't have that primary evidence, which is always the best, whether that's through interviews or surveys, then you can cite secondary sources, like maybe there are certain analyst reports or other things in the press that are kind of citing this as an issue. That's great. This is easier said than done. Obviously, you're all innovating, you're doing something new, and so there's probably people maybe are not talking about it yet, which is fine. But it's up to you then to go talk to people and validate what you've thought about, because you want to make sure it's not your imagination, it's a real problem or a real issue. So that's customer analysis. Customer analysis is going to think of that as kind of the micro view. That's really understanding the individual who's going to buy the product or use the product and their needs, and how the products that are out there today have shortcomings. The market analysis, I think of it really as kind of the broader space, if you will, not only the customers, but the potential partners and competitors. And the biggest question that I always ask folks, and you imagine how many times people stumble on this, is answering the question, why now? Okay? We like to just assume that every idea has been thought about before at some level. Maybe not the exact way you're thinking about it, but in broader terms. What's really exciting is when someone can explain, yeah, people have been talking about it maybe for 10 years, or you've heard about it, but now is the right time. Because certain environmental things are happening in the market, or certain technology changes have happened over the last few years that make this possible today in ways that it wasn't possible before. Because during the dot-com boom, people thought of everything, and a lot of it didn't come to fruition until now. And that's because they were anticipating ahead of the curve on a lot of trends. So being able to answer that, I think, is important, and kind of give the sense that now's the time to take advantage of this opportunity rather than before or even after. You want to also show that you're not ahead, too premature. The other important thing is being able to define and segment your market. In my opinion, it's better to be able to show that you've segmented it maybe on the smaller end rather than the broader end, because it really shows that you've thought about okay, I understand exactly who the kind of where the low-hanging fruit is. The people that are going to adopt it today without me having to sell them on it because they want it so much, the early adopters. If you can somehow address what they look like, who they are, that's important, and be able to describe them and understand how big that is and how they behave, even better. You guys know what those terms are? SAM and TAM? Servable addressable market and total addressable market. That's really about being able to say how big is the market that you're selling into. And you can express this in different ways. You can express it in terms of the number of companies, number of people, or you can express it in dollars, that this is a $1 billion market. This is one of the hardest things to do. The TAM you can think of as the total universe in terms of what you're selling into. You may not be able to sell them today because you don't have the right products, but 5 years down the road you'll be able to grow into it. Whereas the SAM is what you can serve today. What, with the products that you have or are about to launch, you'll be able to address them immediately. And be able to show how that SAM grows over time as you add new features or as the market develops. An understanding of that is great if you can do it credibly. But when people try to measure the market, the biggest mistake I see is that they only do a tops-down analysis. So what this means is that you say, oh, people are spending $20 billion on X, and this is the kind of like on solutions for helping their sales force, say. And I'm just going to get 1% of that. Well, 1% of a big number is always a big number, and so people are get very excited about that. But that doesn't really show anything, because everyone always says I'm going to have 1% of something. What's more important is to be able to say that, okay, if I'm going to do this tops-down analysis, I'm going to say, okay, I'm segmenting it, and I really understand that of the $1 billion market, I'm really addressing the needs of this sub-segment of it that might be small today, but it's going to grow over time. And I'm really only going to focus on this sub-segment, the ones that happen to be in this industry vertical. And beyond that, I'm going to only start selling initially in Texas. And then you start getting into talking about, okay, this is the market that you have and you can address today. And it's small, it's something that it might be small, but it's something that you can believe in because you understand the numbers better and you understand your ability to capture it better. The bottoms-up approach is also important, and I recommend you do both. Bottoms-up really means that you think about it, rather than from the size of the market, you're taking small segments, you're thinking about who you're going to address, how many you're going to sell in the first year, how many people are like you, what price you're going to use, and you actually build it up based on kind of your model that you're building. And so it's more based in your sales plan, it's based on the real number of companies that you have that you've identified for real, as opposed to kind of taking percentages of bigger numbers. So I don't know if I was clear enough on that, but the idea is try to measure your market using different methods and different angles, and the best thing is if you do it 2 or 3 different ways, what you'll find is you'll start to be able to triangulate on a number that's believable. Because this is all kind of swags or silly wild guesses. You're making estimates. And to build credibility is to just show, hey, I tried it a bunch of different ways, and it all kind of started to point to this rough range of how big the market is. And that's more believable. People will accept that a lot more. Yep.
Should they match?
No one's expecting them to be identical, and I wouldn't try to make them match. That's defeating the purpose. It's really about just showing that, hey, you tried it 2 ways, and here's a lower bound and an upper bound. And and if their magnitude's off, then you have a problem. But if they're within a certain range, then people get it. And this is hard to do, especially for new markets that are untested. And so sometimes you want to add, actually, this part here, which I'm talking about here, is the time dimension, which is, it's really small today, but it's going to grow over time. And you shouldn't forget that dimension when you're talking about markets, because if you're attacking a new market, the idea is that it might be small today, but it's going to be really big in the future, and that's really the opportunity you're trying to address. So you want to relay that message. On the scorecard, it said products and services, and I'm adding another one, which is GTM, which stands for go-to-market strategy, which I thought was kind of odd that the judge's scorecard was missing that, and I'd recommend you guys add it, because it's not just enough to talk about what your product does, or what service you're going to deliver, and you know what the experience is like. Your product is not just the technology, it's not just the widget, it's everything that surrounds the product, or what some people call the whole product. So that's the way you're going to talk about it, the way that people are going to perceive it, the way that it's going to be delivered to them and sold to them, the way they're going to use it, the way it's going to be supported. You know, all of that, the way you take that product and introduce it into the market and the way it exists in the market is important. You have to kind of think of it from kind of that 360 view. And when you're doing that, the best way to do that is really speak in your customer's language. Don't speak in the language of technology. I talk to a lot of engineers and technologists who are starting companies, and they love to talk about it in terms of some language that they used or some new technology that makes it special. That's interesting, but that's not what your company is. Your company is always what your customer, the way your customer describes it. That's your product. And so, understanding how people talk about it today, even if the interesting thing here is sometimes you're doing something brand new, and your customer doesn't even really, not really aware of it yet, maybe. But in their mind, they're still going to put it in some bucket or category. They're going to say, oh, this is like X or like Y. Because I already spend money on solve a problem that's similar, and so I think of it in that way. You might use an analogy, but as much as you can use a customer's vocabulary for describing things, the better. The other thing when you're talking about your product or service is, and this is when you're talking about it more about to your investor, more than so than when you're talking about it in terms of how you market it, is what is the secret sauce? What really makes you different at the end of the day? You may have 20 different features, but if it's just a features game, if it's just that, oh, this guy has 10 features and I have 15 features, that's not interesting to most investors, because you know the competition's going to have those 5 features too, eventually. Really what you're looking for, what's the fundamental thing that gives you that advantage over time? And be able to explain that in a way that, the best way is to do it in the customer's language, so the customer also understands it and how it affects them. But if it's something that's technical, that's fine, but you want to be able to explain that very concisely in terms of what you do that's different. It gives you the advantage. So like I was saying, your product is not just the technology, but it's the go-to-market strategy. And so that includes a lot of different things that you might want to address. It's how you're defining your product. So when I say product definition, that means, you know, your product can be sold in many different ways. You can bundle it. You can have maybe a free version and a paid version. You might have a low-end version and a premium version. Or if you're selling, you know, beer, you know, it's a 6-pack, 12-pack, whatever it is. But there's different ways that it's defined. And there's different ways that it's positioned in the market that we talked about earlier. So this is a great way to talk about, in people's minds, are they going to think of you as the fastest, the easiest to use, the cheapest? What is it in their minds that you're positioned in a different way? And then what's your marketing, distribution, and sales plan? You don't have to get super detailed in here, but I think at a high level you want to talk about what is, you know, one of the 1 or 2 key marketing tactics you're going to use initially that's going to get you over the hump in terms of building awareness or educating the market and setting you apart. What are you doing in terms of distribution? How are you going to actually get the product in front of people? If it's software, you know, is it being delivered over the internet? How are people going to find you? How are they going to buy you? Is it through an app store in Apple? Like, what you know, on an iPhone? What is that? And then what's your sales plan if you're selling? So are you going to hire 1 or 2 salespeople initially? Who are they going to go after initially? With what message? What's a good? What's your goal in terms of the first year? What they're going to be able to achieve? Again, I know it's a lot to try to fit in 5 pages, but even if you allude to it and to show that you've thought about it and you can concisely describe it in 1 or 2 sentences what you're going to do, that's great. Business model and pricing, that's, you know, how are you going to sell it? Are you going to have a free version and a paid version, like I said earlier? How much are you going to charge? Do you make money off transactions? Do you make money off advertising? All of that kind of stuff. And simple is better in all of these things. You know, you don't want to go and have like 5 different price levels and 3 different bundles and things like that. You know, 1 or 2 is probably good to start with. Keep it simple, but make sure that you're addressing that you're thinking about it in this way and you've thought about it holistically. So that this is where consistency comes in. Where I said consistency is so important. You'll often find that people will talk about, oh, I'm going to market it this way, but that doesn't make sense necessarily in the way that they are pricing it or in the way that they're going to distribute it, because they haven't thought about certain things like they need a channel or other people that they partners or things like that. So as much as there's consistency in all of this, the better. Okay, this is a very important one, you know, competition. And one of the favorite ones that I love to hear, I hate to hear from people is, oh, we don't have any competition. I did Google searches and I searched and I couldn't find anyone doing exactly what I do. Okay, maybe there's a reason. Maybe there's no market for what you're doing. That's one reason, right? Maybe people have tried and failed, or you're just not defining the market properly. So what I mean by that is, remember that there are always things like substitutes, or people are if they have the problem today, they're solving it in some way. And if it is so new where there are no other competitors and you're ahead of the curve, then you have to be very clear that the market is really small today, and people don't know, and you're going to have to do a lot of evangelizing to get people to understand that there is this opportunity or this alternate way of addressing the problem that they have. Another way that you have competition is this doing nothing issue. Sometimes people know that they have a problem, but it's not a big enough problem. It's not urgent enough. And so they are willing to wait another year or 2 years before they make the investment, if it's a B2B thing. Or they're lazy. I mean, do not underestimate how lazy consumers are. Anything that you make it easier for someone and they have to be more lazy, that's actually a good product. Anything that requires work is very, very hard for a consumer product. So you're always competing against that do nothing. And so you have to be able to recognize that as a barrier in what you're doing. The other thing that can really show that you understand your space is if you can articulate what the basis of competition is. So, it's very common for people, like I said earlier, they'll list, oh, I'm going to do a 2x2 matrix, and these are all the features, and these are the competitors, and I have this and this and this, but they don't have this and this, and so what? Is that what your people are competing on? Who cares if you have 2 more features if all the customer cares about and where the competition comes down to is this one feature or a price or something like that? That's really what you need to be competitively advantaged on. So really understand what the basis of competition is and articulate that precisely. And this is the one that I care about most. Actually, when I look at companies, because we invest in companies that we hope will become really big one day. And companies that can be really big one day are usually companies that can take the entire market or really big chunks of the market. Kind of winner take all or winner take most type dynamics. And so those usually have some sort of advantage that is not just in the first year, but it gets better and better over time. As the company grows, the advantage grows over time. And that's a virtuous cycle, right? And that makes it better. So these are some examples that I can walk through a little bit. But if you can find this and credibly talk about how you possess some of these in your business, it's exciting to a venture investor who's looking to invest in companies that can grow really big. The first is really economies of scale. So as you get bigger, your costs go lower and lower significantly, and so you'll have a price advantage. And usually economies of scale businesses also means that the basis of competition is price-based. And so you want to, again, this is where consistency comes into play. If you say I have economies of scale, but people are not competing on price, then it's not consistent. And so you want to look for that. Network effects, for those of you who haven't studied that yet, that means that the more people using your product, the more valuable it is to them. So Facebook's a great example. The more people on Facebook, the more valuable it is to you, the more of your friends are on there, and the more sharing you can do. Telephones, faxes, all of these things have network effects. The more people using it, the more valuable it becomes. Or there's other kinds of network effects where there's two-sided, like markets. So eBay, buyers and sellers. The more buyers there are, the more valuable is the sellers, and vice versa. So if you have this, you build a sustainable advantage when you do that. Because the bigger you are, it's harder for a new guy to come in and compete because they don't have all the same stuff you have in terms of the number of people using the product. Data scale, Yelp, you guys use Yelp, has all the reviews. It's really hard for a new guy to compete with Yelp because he doesn't have millions of reviews already on there. So they have, as you collect more data and you get bigger, you have an advantage. Brand is an obvious one too, but that's, you can't start with brand. Brand is something that you get built into, so it's kind of more of a side effect. If you're going to say that I'm going to build a big brand by spending a bunch of money on marketing, that's probably not going to be a convincing business plan. Distribution advantage. If you have a certain kind of partnership with someone, exclusive partnership, or other way to get to a customer in a way, or you have real estate is another way of thinking about this. So you have a real estate advantage, it's a green field, and you're going to gobble up these spots, and then no one else is going to be able to take that position, have that real estate, and then you're going to have an advantage over time because you're going to be able to serve people in those geographies or in that niche in a way that other people couldn't. So look for these, call them out specifically, and explain how there's a virtuous cycle there and that makes you stronger over time. Now people love to say patents, IP. I think that's important in some kinds of businesses. There are definitely certain businesses like biotech, some sorts of clean tech, manufacturing, where there's a patented, very proprietary process that's really hard to replicate. It gives you a really big advantage. A lot of those come out of universities, so I'm sure some of you might have that. That's great. Patents are really important, and that can be your competitive differentiation, and as long as that's also part of the basis of competition in the market. But if you're just going to patent a bunch of stuff, and other people have patents too, and you're a small company, you're not going to be able to defend that. You don't have the money to defend that, and people can engineer around it. Don't tell me software patents. That's the worst, right? I mean, that's going to be a dime a dozen, unless you have some really hardcore algorithm. That's really interesting. Patents really are good, but that's not really going to do it. Management. Now, this is hard because I know when I was in business school, I participated in a business plan competition, and while you may have some credentials that apply to the domain, you're probably not going to be the best team out there in the world to attack that problem, right? You might have a technical person that is maybe the best scientist or engineer to solve that, but at the end of the day, the team as a whole is probably not the best, so, which is fine, but it's still important to be able to articulate why you're a good team for at least starting the business off. And so you're not going to be able to maybe address this problem head on, but you can be cognizant of the fact that you may have gaps, that you have maybe weaknesses, and how you have plans to address them. It shows a lot of maturity to be able to say, we really don't know how to sell to this target customer. No one on our team has ever done it, but that is like #1 on our list in terms of recruiting. We're going to find someone. Or we've already found someone that's willing to come on board once we have funding or something like that, in terms of advice. Or you fill them up with, use advisors and other things like that to help address gaps. But being very cognizant and honest about that really builds credibility. The other one is title inflation. You don't need CEO, CMO, COO, all of this, right? You need a CEO, no co-CEOs. That's also a red flag for investors. One leader, the person that's most dedicated, has the vision, figure it out, and commit to that. And then, or you can say, hey, you know what? I'm an interim CEO. I believe I can be the CEO for the first year, but I really think that at the end of the day, I want to recruit someone that's more senior to me to help run this. And that's fine. And I think that shows a lot of integrity, but you have to mean it and believe it if you're really doing it. And then for the other folks on the team, director level is good. You don't have to be VPs of everything either. Again, I just think when I'm dealing with younger teams, I think that shows a sense of maturity as opposed to thinking that you're going to run the whole thing. Yep.
How valuable is talent management's insider expertise or specific industry expertise? Yeah, like I said, that's absolutely the best, and you want to highlight that, but you don't want to overdo it. So, if you're trying to make a weak connection,
it's better to just avoid that completely. But if you have a strong expertise, absolutely, and I know a lot of folks, come from different industries, coming to business school and maybe going back into that industry, and that's great, and you want to highlight that as much as you can. And if they have certain experiences functionally, like they've actually sold to this group, or they've marketed to this group, or they've actually engineered a product that scales to that level, then you absolutely want to highlight all of that. And be very specific about how you think their past experience maps to your needs in that first year, when it's going to just be you guys and probably not be able to recruit folks initially. Financials. This one is one where I've seen people either two ends of the spectrum, really too light on the financials, or too heavy. And so there's a way in between. So I'm going to say numbers are less important than the model. Doesn't mean numbers don't matter, but at the end of the day, in early stage companies, the numbers are bullshit, right? I mean, everyone is making a lot of assumptions. You're guessing a lot of times. You're hoping, and everyone knows that, and that's fine. The clear thing is to be very cognizant of what those assumptions are. Try to defend them as much as you can, in terms of, like, we think this is going to be the number of customers that we can touch from a marketing standpoint, or convert, for instance, in terms of percentage in the first year. Well, why? Did you run a beta test and you got a sense of that? Did you talk to people, or are you looking at what other companies were able to do in their first years? If you have any kind of evidence that supports your assumptions, that makes it a lot more credible. And then, it's about the model itself in terms of, do you really understand what the drivers of the revenue are? Do you understand, your pricing is another big kind of variable or assumption that you make. That why do you have confidence in this pricing? If you can do sensitivity tables saying, hey, we understand that, these are the 3 or 4 drivers of the model, and these are the assumptions that we're making, and this is how sensitive our model is to that, that's even better. And you can show that, where the kind of the range of low and high scenarios are for where you may come out. That's always great. All right, this is another one. Consistent. You have to be consistent, again, like I said, with what you said earlier about this market sizing and the go-to-market plan. If you say you're going to sell X number of, or you're going to reach a certain number of revenues in the first year, well, that implies a certain price, which you're going to defend in terms of why you think you can achieve that price. And it assumes a certain number of people that you're going to sell. Well, that then means that you're going to convert people at a certain percentage. So that means you're going to touch even a bigger group. Well, how big is the market? Is the market even as big as you're saying it? Are you going to touch 50% of the market in the first year? If you're claiming that doesn't sound very consistent. Are you going to win 25% of the market in the first year? Probably not. But if those numbers don't match up, and suddenly you're saying that you're capturing the entire market, or 110% of the market, which I've seen also, then you know that there's something inconsistent. So double check and make sure that, just because I know people have a tendency to split up the work, right? Oh, the finance guy's going to do the spreadsheets, and then I'm going to do the marketing stuff. And if you don't really check your numbers and make sure that you guys are saying the same thing, it hurts credibility. Again, here again, what are your biggest assumptions? Being able to tell that and be upfront with an investor on that is key, because that's what they're looking for. I'm always looking for what assumptions has this person made, and how confident can I be in them? And as much evidence as you give to make me more confident, the better. And what are the big drivers, not just of revenues, but of your expenses? How do your expenses scale as you get bigger? Being realistic about that. A lot of folks, say, oh, we're going to get to this many customers and revenues, but they haven't really added overhead in terms of thinking, oh, but I'm also going to eventually need maybe an HR person, or I'm going to need a lawyer because I'm going to do so many deals, or I'm going to need, there are all these other expenses and overhead expenses that people don't build into it. And they think that they're just going to be, them and their buddy and a salesperson, and that's it. That's not the case as you get bigger. And that's the same true with web companies, where maybe you don't have a sales force, but you need to start spending more money on support and other things like that you might not have thought about. And the most important thing when you're kind of showing that one, and in the executive summary, right, at the end of the day, you're probably only going to show one table of stuff. And it could be a graph. But it's even better if while you're showing those numbers and you're showing those assumptions, that you somehow overlay, key stages of your company, key milestones you're going to achieve, so you can understand why certain inflection points might be happening. Why are you suddenly being able to grow really fast this year versus the year before? What did you do, or what did you achieve that allows for that growth? What kind of underlying metrics in terms of traffic to your site or something like that are tied back to that revenue number? So if you can show that's important, because we're always looking for what the drivers are. This is all about status and offering of the company. This is where are you today, and how much money are you trying to raise, and what are you going to do with that money? And so what have you accomplished to date is important. Showing that you have momentum, that you've invested some time and effort, that you've achieved something. The more you have of that, the better. How are you going to use the money? Really realistically, you're trying to raise, you're going to raise $500,000 for the first year to test out X. Okay, well then what money do you have to spend to be able to run that test? On who, on what? And thinking about it in stages is really important. That's how early stage investors think about it. They invest a little bit, run a few experiments, learn some information, feel more confident about the assumptions, and then put more money in. And so your milestones are really about proving out the assumptions that you're making, or giving more confidence behind those. And that reduces risk, creates value in the company over time. And it's important to also think about not just how much money you need right now, but what you'll need in the future to grow. Because investors, if they want to be able to maintain their percentage ownership, need to participate in each round of investing, or want to. But if that means, as an investor, I have to, in the lifetime of the company, to maintain my 20% or something, I have to put in $15 million. Well, if I'm a small fund and I can't afford to write $15 million for one company, it's a non-starter for me. So being able to understand what the longer-term capital needs are to get to beyond cash flow break-even is really important. And finally, your investment potential. So this is, why are you a good investment? This comes back to that competitive differentiation thing that I was talking about earlier. And that's why I said it's so important, because that's the way we think about it from a value creation standpoint also. What are you doing that gives you sustainable advantage over time, and that creates sustainable value at the end of the day for the company? So that could be the customer base that you're acquiring over time. Even if you're not making revenue, but you're attracting a bunch of customers, that's valuable to someone who can think of a way to maybe monetize them later. Twitter is a great example of that. Partner and distribution networks. Maybe you are doing a bunch of business development deals with a bunch of key folks, and that distribution advantage or partnership advantage is kind of you're creating an ecosystem around you, and that's going to be hard for people to replicate in some way. Or those are the potential acquirers for your company. We have a lot of companies that get bought by the companies that they partner with. We have a company that partnered with AT&T and built out their entire Wi-Fi network. It's called Wayport. And so, you see the free Wi-Fi hotspots from AT&T and Starbucks and McDonald's and places like that. That was Wayport's network and capability, and AT&T hired them basically to run that for them. And then eventually they said, hey, we want to own this in-house, and they brought it in. And so you can get bought by your customers, your partners all the time. So that's of value. So being able to show that that's what you're accumulating over time. Or it might be data and content or real estate, like I talked about earlier. It might be that unique technology. It might not have anything to do with this. It might have to just do the fact that you have this great technology that gets better over time as you invest in it more, and that's going to be really hard for someone to replicate. And that's what I'm buying at the end of the day. Or it just could be pure revenues. You're just going to generate a ton of cash. That's the easiest one. But for early stage companies, they often don't get value on that. They're getting value on these other things. So be cognizant of that and how you're driving towards that, and optimizing your strategy to maximize the one or two that you think is the real value driver. That's important. You also want to talk about your likely acquirers. So, I'm not saying that you should build your business to be bought necessarily. But if you're going to raise money from venture capitalists or angel investors, they are often looking to get their money back at some time through some sort of exit. And that either means the company is bought or it IPOs on the public markets. IPOs are less common these days. Most companies get bought. So it's nice to be, again, cognizant of who might buy you, why they might buy you. It might influence your strategy a little bit, but it shouldn't. I mean, at the end of the day, you're building something because you want to maximize the value creation, not who's more likely to buy you. But if you're aware of that, that's good, because that means that you're relaying to the investor that you've at least thought about it and you understand the dynamics of the marketplace. And if you can find analogies or analogs from the past where, hey, I'm kind of like this company from the last generation of technology that did something similar, and then they got bought for this amount when they achieved a certain size. If you can show that pattern, that is awesome, because investors are always looking, they kind of pride themselves as being good at recognizing patterns and investing based on that. And so if you can somehow articulate that, again, credibly and not in a stretch, and not doing it just for the sake of doing it, but it's something real, then it's good. And it will definitely help you get an investor more interested and excited about the opportunity. So that's it for me. Sorry if I was rambling in some of that. But if you have any questions, that's about it. Yep.
Do you mind sharing that presentation?
Yeah, absolutely. You can do that. Anything else? Yep.
Actually, the first, I think it was the company summary, you said it should be big or something like that. In terms of dollars, what were you?
Would it,
I guess.
oh, I'm sorry. What I meant by that is, okay, on the long-term vision. Yeah. So again, I'm sorry because I'm giving you the perspective, and I should have kind of started this. I'm giving you the perspective as a venture capital investor, which is someone who half the companies fail because they're so early stage and high risk. And it's kind of like video games and movies, and a couple of them do really, really well and make up for all the losses. And so in our success scenarios, we're looking for companies that can get really big in terms of revenues, or getting bought for a high price, even if they don't have that. So, the initial, what you're going to do in the first year strategy is interesting, but we're always thinking about what are you building towards, and what do you imagine you can become from that initial strategy. And so we like to see that kind of ambition and that story. That being said, I can't speak for all of your business plans, but I'm guessing some of them are going to be maybe lifestyle businesses, where, by lifestyle businesses, I mean, maybe you're not going to raise outside money, or you may raise a little from friends and family, and it's something that can, pay the bills, and you'd be happy. It may grow, but it's not going to necessarily explode really quickly, like venture capitalists are looking for. In which case, that might be not as important. And a lot of the things I said may not be as important. I'm giving that perspective for kind of what we call high potential ventures that can get really big. Yeah.
You recommend writing the executive summary with bracketing points?
In this order or in bullets is what you're saying?
Yeah, bullets with just each of the 8 points and then paragraphs below.
Yeah, I think sections are absolutely important. I think for the purposes of this academic exercise, it'd be good, since people are going to be judging you based on this scorecard, I don't think it hurts to make it clear that you're, hey, now I'm talking about this, so you can, but, I wouldn't necessarily say you have to use all of these, or you can combine a few of them, and you may present them in a different order. So actually, I had added in my appendix here. This is what we use what I recommend for slides, for presentations. I stole this from one of my favorite venture capital bloggers, and this kind of almost lines up pretty well with what we were talking about earlier, but I think this is also a very good order in which to talk about things. And it's very similar, but if you don't, for instance, if you don't have much customer adoption or traction, you obviously don't write it for the sake of writing it as a separate section. You can maybe group that under something else. It's up to you in terms of which ones are longer and shorter, depending on what you have strength on. You don't just fill it up for filling it up's sake. I think that's the worst when you're just reading empty text that really doesn't have value. Thanks, guys.